Good afternoon, traders. This is Christian from Hertz Tropic Trade Group, and this is your end of day video for Thursday, February 9th. Themes of the day. Well, you could probably come up with your own themes for the pretty ugly price action that we saw today. I would call it a washout day. Also a reversal on poor breadth. Risk disclaimer in front of you. Everything that we're going through is for information purposes only, not giving out any advice or recommendations. Everything that we're going through is for information purposes only. So yes, we can kind of start with that, the reversal on poor breadth. It was one of the things that I noticed earlier that was a bit troubling, was that the market breadth opened up positive. We can kind of look at this for the S&P. And the breadth is any chart that I look at, this is the overall breadth for the market. But if you look at the bottom of your screen, we opened up very positive and we started to kind of deteriorate a little bit in the first hour of the day. And then of course we just, kind of just the trajectory just was just continued to the bottom right, lower and to the right. I was watching NASDAQ, as NASDAQ just sometimes has more momentum. And here's where we kind of started, and right off the bat, which we see this on a number of days, where we just kind of start a little bit lower, especially when there's a little bit of a gap, like a positive start. And then really we were hanging around this top of value. And one of the things that I said in the trading room was, and I also said this I said it on Twitter too. I said, be careful if we slip into the value area. It usually doesn't bode well when we start positive like that and we break, because then you have the 80% rule. And it's one of the things that I've tried to be a little bit quicker this year on, is that capitalizing on these 80% rules. So what does that mean? You can click on my you can click on the link on my profile page in here, and you could always, my pin tweet tells you about the market webs. You can click on here to learn more here, and it will tell you things about what the 80% rule is and what a aversion point of control is. So again, it's always pinned to the to my profile page, but I will go through it very quickly for you. It's just when you move inside the value area, right? So again, this value area is based on all the price and volume that occurred yesterday, right? So it becomes significant when you enter it, that there's an 80% chance that you're going to go all the way from one side to the other. So that's what I played today. I grabbed, even though I'm looking at NASDAQ futures, what I typically play is SQQQ or TQQQ when it goes the other way, right? Because that has the most more volatility normally than the S&P. All right, so where does this lead? So then of course we kind of hung around here for about, this was around the 12 o'clock hour, and we just can kind of continue to to go lower. So a little bit, if you look at yesterday's price action, yesterday we was a down day too, but we went sideways there and had a little bit of a midday bounce. So where does this leave us? Well, there's a couple takeaways. I'm going to switch back to the S&P chart, because I think the S&P is most important when you're looking at some of these things. But this was something that we touched upon in the weekend video, was that remember, we took out this upside target, right? Speaking of aversion point of control, that was a really good one to watch. And since then, just the market it's been slippery when it gets up here. It can't get up here. And yesterday I actually drew this downtrend line thinking, hey, it may be a pennant. It's possible, right, that this was a pennant. Right now, this is revealing itself that it's not a pennant anymore. And that's what trading is all about. It's making adjustments. You have ideas, and when the price action proves you wrong, you don't want to stay anchored to what you thought was happening, right? You want to adjust to it. At the end of the day, I was just going to kind of talk a little bit about investor psychology, right? But at the end of the day, there's so many traders that want to be right rather than make money, right? My job, I think my job as a trader is just to be on the right side of the market and recognize when something is changing, right? Take off risk when something is changing, right? Add risk into dips, right? So we don't know yet if something is changing. And I did a little bit of a combination of that today. I took off a couple of trades. I added, a little bit of, some a couple existing trades at the end of the day. Well, why would I do that? Well, because we're into the support level that I mentioned over the weekend. We're into the top of value. And I said, hey, I thought that this might be a good buying opportunity, but we still need some confirmation, right? We've now seen just about every day. Well, sorry, I don't want to say every day this month, but we've seen a pretty decent decline in breadth, right? That was one of the strong. So I was on Bloomberg TV and I was talking about this earlier, but you could bring up the NYSE McClellan Summation Index. You can bring up the advanced decline line. You could bring up any of these, and the breadth has been declining, right? So that's, if we want to bring up just so that you have some reference. But I know this, on stock charts, which is where I grab it from, the NYSE doesn't update till like 5:30 or 6 o'clock. So here's what this looks like. And I'm not sure this hasn't updated yet either, right? But again, this is advancing versus the declining. This is just for NYSE, right? And it's the analogy for a trader that we typically, that I use, we typically use at Tribeca Trade Group, is that when you have more advancing versus declining issues, the wind is at your back, right? When you're going long, essentially. When you have more declining issues, which is what we've had in February versus advancing, right? The wind is more in your face, right? And it's much harder. So this is going to take some time to sort out to see, hey, if this is going to be another pullback. And again, this is just advancing versus declining issues in the NYSE, right? We had this big move up as well in the summertime, and it halted in August, and it really fell back to the downside. And we don't know yet if that's going to happen. Do I think that it's going to happen the same? Something like this is going to happen similarly. I don't think it's going to happen similarly, and that's why we have levels to watch, right? So a check back to the top of value is not a bad thing. But we're going to want to see price hold in here, right? And that top of value coincides with the 20-day moving average, right? I use the 20-day and I use the 5-day, right? So we did lose the 5-day moving average today too, right? We were kind of holding in there for the last couple of days. So, I always get this question about, some people reference the 8-day moving average or the 10-day moving average. None of these are going to be 100% like that's what you have to use. It's whatever you're going to make a decision on. So if you're a super short-term trader and you use the 5-day or the 8 or the 10, and price starts to cut below that and move and slope down, right, then you have some decisions to make. I do use that, and I also use the 20-day moving average. So I do try to cut some exposure when we lose the 5-day moving average. So that's generally how it is. But again, this is going to be remains to be seen yet, whether that support is going to hold. Now we only have one more day of the week. Kind of snuck up on me that we only have one day of the week, but yes, the 80% rule is also in play here. So if we get some volatility, 40.28 could be the level that we come down to for tomorrow. But again, as the week kind of, as we get closer to the end of the week, we're right at the middle of that value area. But so I don't know if you're going to see that move, straight down through to the bottom of value. Because we only have one more day. So again, you have to think a little bit logically. If it was Tuesday or Wednesday, I would say, hey, 40.28 could be something to target. All right. Just going through NASDAQ as well. NASDAQ was holding above value, and that broke in. I don't think there's anything that we could really take away yet. This was acting stronger and has lost the 5-day moving average. 20-day moving average is all the way down here. Let me just pause this 1 second. All right, and then when we look at IWM, IWM has really been trailing this month. That has been kind of one thing that's just stood out to me was that the small caps have just been falling a lot faster, right? And showing some risk off. Now, just like the S&P, they're into support. And again, this was something that I put on Twitter earlier. I said, you know, when small caps were they were just barely down on the session, they ended up closing down about 1.5%, and they're kind of right into this 190 level, 190.20, and also into that 20-day moving average. So to me, like, you know, here's a big test, right? And we don't know, we don't know if the price action is going to fail the test or pass the test. It's too soon, right? So we'll keep an eye on these things. You know, also when you look at the performance too, well, look at this, right? This is ugly. But look at the 5-day, right? So IWM is down 4.2% in 5 days. So again, that's what I've been referring to as leading lower, and for the month, it's also down. Now, also look at, you know, some things like ARC, right? And one of the things that I've been talking about recently is that you're going to start to see a separation in some of these areas. Remember, everything kind of rallied, you know, really hard in January, but that's not sustainable to see everything rally. You know, in some of the, you know, biggest short, you know, areas of the market, such as ARC, such as blockchain stocks, right? You know, there's once those shorts cover, you know, that trade kind of ends if there's not much more to behind it, right? If there's not much more fundamental, you know, if there's no fundamentals behind the story, then it's troublesome. You know, so that's why I think that you're seeing the air come out of those things, you know, quicker, right? You know, we're not in the market of you know, where the Fed is inserting liquidity. In fact, it's the other way around. So those things tend to do well when you have the Fed, you know, inserting liquidity into the market, and you don't have that right now. Speaking of which, we're going to talk a little bit about interest rates because I think that's important. Again, this is the short-term rate. This is what the Fed controls, right? This has made an adjustment. We talked about this. I think I didn't do a video yesterday, so it was Tuesday, and I talked about how the rates have adjusted to both the jobs numbers, the economics, and what all those Fed speakers, including Powell, has said. This was at 4.89. Now it's at 5.13, 5.14. So it is moved, right? And it's moved about 25 basis points, right? And that's reflected too in you know, the implied rate month to month. Okay, now what about the long end of the curve? Right, and that's something that I think more and more people are starting to watch. We talked about this level the other day, 128.10. You know, we had a bounce yesterday. We had a bounce this morning, but we had a bad bond auction, and that caused this to reverse. So again, my thoughts very quickly. Somebody asked me about this on Twitter. They're like, "Well, what does this mean?" I'm like, "Well, yep, watch the video, and I'll give you the take. Or you have to be a member of Tribeca Trade Group." But again, I see so many people who ask questions and they don't know some, and again, I'm not being negative towards anyone, but you know, that's why you sign up for things. To this way you get education. It's what I try to provide, as well as, you know, good trade ideas and so forth. But you know, if you're new, either if you're new or you don't know some of these concepts and why they affect equity prices, right? These are some of the things that I go over, you know, when it's necessary, and it's starting to get necessary. Because if we break out of the sideways range and we start to see volatility increase in bond prices, it will most likely spill over to equities. Why do I think that, or why do I know that? Because when this happens, right, and when you know, bond prices were going down, which means yields are going higher because it works inverted, right? That's how a bond works. When a bond price goes down, that means the yield is going higher. So, you know, you could look at this backwards too. You could look at straight up yields if you want to. But regardless, when this happened, right, when we started to really leg lower in bond prices and yields went up, you know, equities, the VIX went up, right? So this was the period. And if you don't believe me, even though the VIX doesn't measure that, right, this was August to, you know, this was, you know, yeah, right in the beginning of August to October, right? You could see what the VIX did over there. The VIX climbed, you know, from about the level that we're at, 20 to 32. So we don't, you know, if you're an equity investor and playing things mostly on the long side, you go back to bonds. You don't want to see this really start to pick up steam to the downside and recheck back here. Right? That will not, in my opinion, I don't think that that will be very good. But if we can hang in here, right, and go sideways, then we might see something different than what we saw back then. And then finally, just to go over the dollar, this did jump today again. Like both of these things started down, and the even though the US dollar finished down on the day, it just grinded back from where it was earlier. So again, we've talked about this a couple of times. Here was the high point for the week, virgin point of control, and a move back, but we're not too far away from those levels. So again, we'll keep the dollar in mind, but right now I'm more concerned about interest rates. So what else, right, is going on besides? And again, I spend more time in these videos going over the indices when volatility is present and when we've got something really going on. What I thought was pretty interesting today, we had a couple names, and I didn't see where these names finished, but the semiconductors were very strong, and they were up at 1.23% for the day. And this was fueled by MPWR, and now this did give back the gains. This is PI, and this name has been struggling a little bit. It's tried to break out a couple of times. There might be some sellers involved in this one. So MPWR did not give back the gains, but PI did, and you could see getting rejected there at the top of value. So what is this? What do these charts look like? This is what I kind of talked about on Bloomberg. Notice this finished green for the day. It's a red candle, but we'll have some more semis that are going to report, I think, next week. But this will be interesting to see if this can hold. Can basically hold up here. Right, and that's what's one of the things that have made me a bit more bullish, because I do like when the semiconductors lead. That's what they've been doing, right? And so we'll see how this group goes. I don't want to go into a bunch of charts right this second, because again, I think that we've got to test in the indices, right? And then we can see if that happens. Maybe some of these areas that may pull back a little bit may provide some buying opportunities. Another thing to mention is the last thing, and this is all macro, but it is what it is for now. We're in this environment of macro, but the CPI, and that's another reason why I think investors are skittish right now. I think everyone is super worried, listening to those 20 Fed speakers yesterday, or however many spoke, right? They are talking about increasing rates more and more and more, right? And the catalyst behind that is inflation, right? So if inflation comes in even if it comes in as expected, that's still too much, right? Because you analyze that, right? So of course, what's 0.5 times 12 months? That's 6%. That is way too much, right? And that's if we haven't had those types of months, right? And again, but it could really distort if we come in at 0.5, right, that could really distort, the overall rate for the year, right? Last month, it was a negative 0.1. The previous month before that was a 0.1, right? In October, it was a 0.4, right? I think that we really want to see this 0.3 and lower, because a 0.3, if you do your math really quickly, right, that's 3.6% if it's 0.3, right? And again, it's not just 1 month. It's, this is month over month over month. So you have to pay attention to that. But, that will go into the obvious, computing of where we are. So, again, macro stuff, but that inflation rate, if it comes at above 0.6, this market's going to freak out, or excuse me, above 0.5. But if it comes in close to zero, you'll see this market bounce and I think anyway, return and go back to the upside. So it's going to be a crucial number come Tuesday on Valentine's Day. All right, guys, have a great night. See you tomorrow.